Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Welcome to our income series. Today you're going to hear from Andrew Lowe, who is the head of technical services at Challenger. If you're wondering what Challenger is, we'll cover that. If you're wondering what head of technical services means, we'll cover that too. What we talk about in this podcast are annuities. Annuities are an extremely popular part of retirement income streams across Australia. And to be honest, they're growing in popularity because, as you'll find out, they try to offer guaranteed income streams to retirees. Challenger is the leader in this field, and so we're delighted to have Andrew on the show to tell us everything we need to know. Don't forget, when it comes to retirement, it's always good to get financial advice. There'll be resources and links available in the YouTube description and in the episode show notes, so be sure to use them or ask a question of Drew and James when we come back for regular episodes. Thanks for watching this episode of the Australian Retirement Podcast. Andrew, thank you for taking some time to join me on the Australian Retirement Podcast.
A pleasure to be with you this morning.
We're going to be talking about annuities, which is something that for many of our listeners, and myself included, I've got to admit, is kind of new ground. It's like the frontier ground for us. But as I'm sure everyone will discover, annuities have been around for a long time. And Challenger is the Australian leader. So this is really, really exciting for us to talk about today. I must also say for everyone that's listening or watching this on YouTube that I'm the stand-in guy. When James from Northeast and Drew Merida from Waddle Partners aren't here, they look to the bench and they pull me up. So apologies for that, but Andrew will make up for everything that's lost here today. Mate, my first question for you is about yourself and your role in particular. I've never met someone that has the title of Head of Technical Services. So feel free to explain to us what that means, what you do day to day, and maybe use that as an introduction to Challenger itself.
Fantastic. I'll start out by saying that's the day job. We find ourselves in late October 2024, and I think occupying all of my time, most of my time, is being the parent of an HSC student, and also a Year 8 student. But the HSC student's the one taking a lot of the time up at the moment, and I suspect a lot of your audience has been through that experience over time. It's first for me, and it's all-consuming. But to Challenger and that head of technical title, it's an interesting one. I'll perhaps start out with what it's not. Most of the business-to-business marketers around the country have worked out that I somehow, incorrectly, have a lot to do with information technology. Okay. And so I get a lot of phone calls looking to sell me stuff for Challenger for IT. It's not what I do. Tech service is a function that exists to help advisors with the development of their advice. And so advice is the landscape in which advice is provided is quite technical, and I think that's the origins of the technical function. But it's a complex environment. It's the interaction between tax, investments, social security, advice regulation. And my job is to make that a little bit simpler, make that a little bit more understandable, simplify some of the complexities, and hopefully build out stories that can help advisors talk to their clients about in particular, retirement income planning. I spend most of my days talking to advisors about retirement planning. That starts pre-retirement. So, we talk about strategies in the lead up to retirement that can help improve retirement outcomes for Australian retirees. And we definitely spend a lot of time talking about retirement in general. That retirement these days can extend for a long, long time, and right into post-late retirement, where aged care becomes an increasingly important part of that. So my day is talking to advisors about that, writing on the topic of retirement, presenting on the topic of retirement. I don't often get the chance to speak to your audience or the likes of your audience, but I really like it when I do. Bring some real life to the stories that we tell. So, for me, I work for Challenger. We're not an advice provider. So Challenger, as you mentioned, investment manager and Australia's largest provider of annuities, but broadly looking to help Australians with financial security for a better retirement. And so, we've got a unique product set in this particular space. You mentioned that for you, annuities were perhaps a bit different. And so, part of my job is also positioning annuities as part of retirement portfolios for advisors and their clients to help improve outcomes for them in those circumstances.
Yeah, so it's very like your role then is kind of cushioned between the advisors and what they're trying to set up as a strategy. So you're more helping them with that deeper, more complex part of things, like the interaction, like you said, between, or what is the impact of aged care, centrelink, and what's that interaction with your assets and how you're producing income for yourself. Like anyone that's been to a financial planner and sees the modeling will see there's this lead up, which looks like a nice like compound interest curve that goes up to the point of retirement. Then there's another part of that chart that then starts to fall away, kind of like a bit of a hill falling away into the distance. But then there's another line that appears that kind of comes in, and that's the government's security system. And so it's kind of an interaction of three things: accumulation, a gradual decline with passive income, and then this other one that kind of underwrites Australians for a big part. Now, we've already dived straight into it, which is the concept of annuities, which is what we really want to talk to you about, because Andrew, this is all about income for us, and that's what we're talking about here on the Retirement Podcast. Let's start at the ground level. If you were to walk up to, say, me in the street, you didn't know me, I asked you what you do, and I said, "What's an annuity?"
Yep.
What's the next thing you say?
It's a financial product that can give you guaranteed income for your retirement. So that guaranteed income will be provided for you over either a term that you're comfortable with, and that could be a really short period of time, or for as long as your entire lifetime, irrespective of how long that might be. So effectively, it's the opportunity to convert some of your retirement savings into a secure source of income to help you sustain your spending through the course of your retirement. I want to highlight that's very much how I see annuities positioned today as part of a retirement portfolio. It's not a case of I'll have either an income stream from my super or an annuity. The most common applications that we have are combinations of those to do different parts of the heavy lifting in terms of retirement planning. And I think you quite neatly introduced the concept of Social Security into the mix as well, because certainly for some Australians, many Australians in fact, an eventual entitlement to a part-age pension or a full-age pension will complement those other sources of retirement income that clients have to sustain them through life. But yeah, that working each of those parts, I think, is a really interesting combination. And you might look to something like a pension from your superannuation fund for the flexibility that it provides, for the range of investment options that allows. You might use an allocation to an annuity for some certainty of a core ridge of income that continues for as long as you live, and then ultimately the backstop of some age pension there as well. So yeah, it's an interesting combination that those income streams provide, and the annuity is specifically there for a level of certainty within a portfolio. And in particular, if we're talking lifetime annuities, something that's there irrespective of how long you live. I think it's fair to say that we often, as Australians, underestimate how long that we'll live in retirement. We want to live long lifetimes in retirement, but very frequently we'll underestimate what that might look like. We certainly see retirees living 20 years, 30 years and longer into retirement. And an annuity can help with one of the challenges of that, and that's making what at retirement is a fixed pot of retirement resources, making them last for an unknown period into retirement. It's a tough challenge to convert a lump sum into a sustainable level of income. If I spend too much, I run out early. I'm dependent on the age pension alone. If I don't spend enough, I live more frugally than perhaps I could have or should have. And so that's a tough challenge, and that's absolutely where I see advisors and superannuation funds working with Australians to help them plan for their retirement and make the most of what they've got.
It's really interesting. You started off by saying that it's a guaranteed income stream. And I think what we talk about on all of our podcasts on the Rask Network, Andrew, is this idea of building wealth and then securing wealth to provide passive income. When we did a survey 12 months ago now, we ultimately boiled it down so that the primary goal of 90% of our audience is passive income. So I want to come back to that idea of guaranteed income in a moment when I asked about you, like with how you construct annuities and what actually goes in underneath them. But one of the concepts that everyone listening to this and watching this is familiar with is this idea that you build wealth probably inside super or outside super, and you can go into, say, for example, with Australian Super, just use as an example because it's the biggest one. You can see the different investment options and what have you, and you can select balanced growth, whatever. Or you go see a financial advisor and they put together a portfolio that they carefully manage for you. Or you do it yourself in some way with self-managed super fund or just building wealth outside of super. What people hear a lot is this idea of a diversified portfolio, having a little bit of everything kind of keeps the doctor away, so to speak. So with that context set, Andrew, I'm hoping you can juxtapose or compare that kind of mix and what people understand with that part of their life to an annuity. Can you tell us how that kind of, if you understand what I'm saying, like how, like that's kind of more actively trying to build something for income, and then you've got an annuity. Can you kind of juxtapose those for us?
Yeah. So for me, an annuity simply fits into that portfolio that you're building, and so you'll have in the Australian Super or any other superannuation fund that you've got a range of different asset classes. You'll have Aussie shares. And I want to, for example, say, I wouldn't be expecting someone to sell out of Aussie shares to buy a guaranteed CPI-linked lifetime annuity. It's not the type of replacement asset that you would have in that particular portfolio. It certainly is, however, an alternative for some of the cash or the fixed interest or other defensive assets that you might hold within that diversified retirement portfolio. And so you might have seen a research paper from Mercer recently. So they released a paper called Mercer's Principles of Annuitization. And what they looked at was the role that an annuity might play in a retirement portfolio as part of the defensive assets of that particular portfolio. And effectively, the conclusion of that research was that by swapping out some of the defensive assets for an annuity, you had the opportunity to improve the total level of income that's paid over a client's lifetime. You had the ability to better manage some of the risks that retirees are exposed to in the form of longevity, market and sequencing risks. And perhaps counterintuitively as well, you were able to actually improve the capital value or the estate value at life expectancy and certainly beyond through that allocation in those circumstances. So this is, Mercer referred to it as the retirement trilemma, balancing those three perhaps competing objectives. And interestingly, it sort of reconciles with the government's objectives of a retirement income strategy that superannuation funds are required to have through this retirement income covenant, where effectively those three objectives that Mercer identified are very similar to the requirements of the super fund covenant. But effectively, what in that particular context, what I'm saying is that by allocating part of retirement savings to something like an annuity with certainty, with some guarantees, and really importantly, the promise of income that lasts for as long as you live. So, no chance that you end up on just the age pension alone. That combination of income streams can improve total outcomes relative to another portfolio. So, if I was to say how does it compare, it compares just like a cash portion of that portfolio does, or a fixed interest portion of that portfolio does, or Aussie equities, property, international equities. It's a component of the whole portfolio that could be useful for the characteristics that it has.
Interesting. And that's a really neat way to kind of understand it. It's kind of part of the bigger pie that comes together. So one of the questions that I had for you is who they are suited for. And I'm hoping that you might be able to answer this from, obviously we're not here to give personal advice. There's a general advice warning that plays at the beginning of every podcast. And that's because we can only speak generally about these things, which is why we talk about getting financial advice, especially in retirement. So that if anyone's going to just get one piece of advice, it's retirement advice.
It is retirement.
Yeah. But when we think about annuities, generally speaking, who are the types of end clients that would be inclined to use an annuity? Now, obviously, the appeal of guaranteed sounds wonderful, and I'll come back to that in a moment. But who are they, and what stage of life are they in?
Yeah. So annuities are typically post-retirement products. There are a range of annuities that can start pre-retirement. They're relatively new and interesting and a growing area of the market, but predominantly a post-retirement decision. And today are predominantly driven by some advice considerations. So it would typically be after sitting down with an advisor or sitting down with a superannuation fund or some advice capacity within that fund environment that a client would be introduced to the idea of a partial allocation to an annuity. Who do they suit? I think there's probably a number of different categories of clients. And the first one would be those clients who are concerned about running out of income in retirement. So that's the primary purpose of an annuity, is something that's there for as long as they live. So that can directly address that concern that a client has. I've got what I've got in retirement savings. It might be a little pot of money. It might be massive. I want to highlight that the risk of running out of income in retirement exists for both of those clients. I've seen clients with modest amounts of money that spend an incredibly small amount and will never run out of income in retirement. And I've seen clients with lots and lots of money who spend a hell of a lot, who are distinctly at risk of running out of income in retirement because of the level of spending relative to the pot of assets that they've got. But yeah, it can be a useful mechanism for helping clients sustain assets for longer in retirement and provide a base level of income. And where I think this is really useful is there's a well-publicized piece of analysis that looks at the costs of living in retirement. So it's from ASPA, and we have this idea of standards of living in retirement. What I think it really does is it highlights the difference in lifestyle and the difference in lifestyle decisions that you have when your budget is equal to either the maximum rate of age pension alone, or secondly, ASFA's modest retirement standard, or then finally, ASFA's comfortable retirement standard. And not surprisingly, as you go from age pension to modest standard of living to a comfortable standard of living in retirement, you get more choices available. You get more flexibility. You get a whole range of different things. You are required to make less trade-offs as your income goes up in retirement. And for example, the difference between age pension, maximum rate of age pension, and ASFA modest level of retirement is not too big a gap. It's about $4,000, depending on the quarter in which you do that. But the lifestyle difference between age pension and age pension plus $4,000 is huge. And so, something like a strategy that you put in place to ensure that come what may, you've got at least age pension plus a bit, I think is really interesting in terms of how it can help clients have more confidence in spending, how it can make them feel more comfortable, how it can give them more decisions, how it can empower decision-making through retirement. So that's the first category, I think, of clients that clients are looking to make sure their retirement savings go the distance. Something like a lifetime pension, a lifetime annuity could be really, really useful. The second category would be those clients who want to improve their portfolio values or estate outcomes. I get that people are more and more prepared to spend their retirement savings. But when we ask pre-retirees and post-retirees what they want, one of the lower tier objectives is to leave something for the kids. And so, an allocation to a lifetime income stream can help that. It changes that variation over time. It can be higher, it can be lower. But certainly when you get out to things like life expectancy and beyond, the allocation to the lifetime income stream can help sustain other assets for longer. And it's those other assets and a higher asset value of those other assets at life expectancy and beyond that can provide a higher estate value for clients in those circumstances. The third category is probably a tactical one, but I think it's a really important one. If you were to ask a pre-retiree or a retiree whether or not the age pension is important to them, many people would say, yeah, I'd like the age pension. If not the age pension, I want the concession card that goes with the age pension. And used tactically, a lifetime pension, a lifetime annuity can help clients get the age pension where perhaps they might not otherwise be eligible. Or if they're eligible for a part age pension, can get them more age pension. And the rationale for that is some incentives that the government's built into lifetime income streams. So if you purchase a lifetime income stream, not all of the purchase price counts under the Social Security assets test. So you effectively have a discounted value for Social Security assets test purposes, and that might mean that your assets fall below the cutoff threshold. So a client couple who own their own home can have a bit over $1 million and still get a really small amount of age pension. Go a bit further than that, and you get no age pension. It's just a flat cutoff that applies at that point. You could manage to reduce your assets below that threshold, get yourself some small age pension and a concession card. That could be really useful in that as well. And the final category I think I'd put is clients that are concerned about the costs of aged care in retirement. And so I have plenty of clients that tell me via advisors that they think they'll spend most in their first 10 or 15 years of retirement, the hard-going years of retirement where I get to do all the fun stuff, where I get to do the stuff that I haven't had time to do while I've been working, while I've been raising a family, all of those sorts of things. And then I expect perhaps my income requirements to dip a little bit. I'm going to move into a quieter phase of retirement. But then I perhaps might need some care, and I might want that either in my home, or I might need to move into residential care at some point. And I think it's fair to say that if push comes to shove, most Australians haven't given much thought to how much aged care costs. I think most of us have got a gut feel that it's not cheap. And as a consequence, I might need something there for that. And so having some source of income that can carry through late retirement is seen as important as well. So if I were to categorise, I think there's some of the sorts of groups of Australians that might benefit with advice from an allocation into a lifetime income stream.
I think this is your bread and butter, right, Andrew? But the way you delivered those categories, those 4 categories, it makes so much sense. Do you, just off the cuff, do you guys do a lot of webinars that non-financial advisors can attend, or is like the Challenger website a good place to go? Because I did ask for resources, but and I will attach them in the show notes. So for folks that are watching,
Challenger.com.au has a range of resources that are intended for both advisors and for average Australians to have a look at. And we talk about the benefits that retirement income planning and lifetime income streams can have for those sorts of applications. Yes, indeed.
Yeah, great. Because even as you were saying, like the couple that owns a home and the cutoff with the age pension and these types of things, I was thinking of some family members that I know that are like in that exact category.
Yeah.
Where I wonder if their advisors had considered annuities as part of that strategy. And I can't remember when I read the statement of advice. I can't remember if I saw that, but that's quite interesting. So when someone says in finance, Andrew, something is guaranteed, there's like a shiver that goes down my spine. Like I think of it and I'm like, oh gosh, here we go. But then if you then, like I'm here in Sydney recording this, I'm in the middle of Martin Place, and turns out you're not that far away from me.
Indeed.
I'd imagine if I saw a Challenger car go past and it says retirement guaranteed income, all the retirees that are on Martin Place would probably have their jaws drop, and they'd probably be wondering, what's that thing? Check that out. But I'm the type of person that would have to go over and pop the hood and see what's inside this thing, like what's actually moving this thing along, because it would be so important to me if I was about to put some of my money into something that says guaranteed on the side of it, that I would want to make sure that I understood basically how it works. So what I'm hoping to do is to peel back a layer, to pop that hood and go, what's inside this thing? Andrew, can you tell us, like, are they safe? How do they put together?
Okay. So I think that skepticism that you've got and that the average Australian has is a really helpful thing. And please, you are dealing with something that's really important to you in your retirement savings, and you should understand exactly what you're investing in. I absolutely get the skepticism around this idea of guaranteed, and perhaps this idea of not much in life is guaranteed is absolutely fair. So I think that's a really useful starting point for that conversation. So I'd highlight a couple of things. A Challenger annuity is provided by Challenger Life, and Challenger Life, I want to highlight, is slightly different from the ASX listed CGF stock that you might see going up and down on the share market day to day as shares do. And so it's not an investment in Challenger Limited. It's an investment in Challenger Life, a life company regulated by APRA, and APRA regulates a range of financial services entities, including banks, insurance, and superannuation industry. So that's the starting point for that analysis. The second thing I'd say is that when you invest in an annuity, you're investing effectively into a statutory fund. There's a pool of assets that are protected for the benefits of annuitants with that in mind. And to that money that's invested by investors, annuity investors, there's a requirement that Challenger Limited, as the entity, makes a co-investment into that particular pool as well. So effectively, it's money from investors, money from the shareholder that effectively go to fund that. APRA requires us to retain a level of reserves over and above the assets that are sufficient to pay out entities. And effectively, we're required to stress test that in a variety of market scenarios. And the standard is effectively testing it against a 1 in 200 year shock to the pool to ensure that we can keep paying annuity payments. And effectively, at the point that in the event of a market event, and market events will come and they'll go, that we fall below that level of required assets, we're required to chip more in. Effectively, that's the obligation that exists to Challenger and shareholders with that in mind, to top up the pool in relation to that. The final thing that I'd say in relation to the security is that we don't maintain just what APRA tells us to maintain. We've got a significantly higher level of capital that's held there for that benefit in those circumstances. And I'll point to things like GFC. I'll point to things like the COVID dip in markets, where every Challenger annuity investor was paid their monthly annuity payments on time, and any capital that was required to be paid was paid to them on time as well. So yeah, that's the sort of certainty that comes from that sort of investment. But I think your starting point's right. Understand what you're investing in.
Yeah, and Challenger's been around for a very, very long time. So this is not something that's like a new thing for people that are watching or listening. It's a business that's been around a very long time. And I think it's important to distinguish, as you mentioned, the very first thing is you're not investing in the shares of the company Challenger. You're getting an annuity, and that's backed by real assets and a lot of regulation, which is a really important consideration there. My next question is, so we know that like the idea of like income is so important, but obviously it's finance and everyone's got to make a bit of money. So can you just talk a little bit, just briefly, about how fees are paid for annuities? Like, what do they cost?
Yeah, so there aren't specific and separate fees that are charged for an annuity investor. Effectively, we bundle the costs of providing an annuity into the price that we guarantee. And it works similarly to a term deposit in that particular context. Effectively, you get what you get. It's on the sticker. And so when you invest, you get a known starting payment, and you get a contractual agreement, a guarantee to change that payment by an agreed methodology. And we haven't spoken about what happens to an annuity after you invest, but you invest an amount. We pay you a starting payment, and then you have the option at commencement for how that changes over time. Our most popular option is a really simple one, our most popular annuity option is simply linked to the cost of living. And so it's linked to changes in the consumer price index. And so that means if the cost of living increases by 2%, that your income payments increase by 2%. And like over the last couple of years, inflation's ticked up a little bit. They've increased by more than 2%. They've matched the cost of living through retirement over that period of time. We offer a range of other options. We offer flat payments, and that they are exactly as they describe. They start high, but they don't change over time. They're completely flat for as long as the client lives. We offer the ability to link these days as well to investment markets. So that's a different type of methodology. That is an annuity that effectively allows for the potential in growth in income with markets, but also has volatility in income payments through that, and that's quite different from our CPI-linked lifetime annuity in those circumstances. But effectively, our fees are bundled up into the cost of annuity. We effectively guarantee to pay a rate, and we invest the assets that a client invests with us. If we make less than that, we effectively need to top it up. If we make more than that, we make a profit, and that's where Challenger makes some of its profits at the end of the day.
So it's kind of like you take the complexity and the risk of the money that's given to you, and in return you give that guaranteed income. And if you do your job well, you're going to make money, basically.
Well, that's exactly how it works.
Yeah. Okay. So I've only got two more questions for you, and they're quite simple ones. But I'm just, as the expert that deals with all of these. I mean, you're dealing with the experts questions, so you're the expert of the experts, so to speak. If you were just saying, like, to our listeners, to me, to anyone that wants to explore annuities because they sound really compelling, what are some tips and tricks you would give to them? Like, what would people be looking for other than just like the idea of, like, we just covered off the fee thing, but like what things would be like, you should understand these types of things? Like how would you deliver that?
Yeah. So I would say, if you're in a superannuation fund in Australia today, as many pre-retirees are, I'd start with looking at the retirement income stream options that are available via my super fund, or might be an opportunity to revisit whether or not that's the right super fund for you and what other options are available. I've been really pleased to see over the last few years more and more superannuation funds offering lifetime income streams. And so your super fund's a good place to start as far as that's concerned. Some superannuation funds haven't yet got there in terms of offering a guaranteed lifetime income stream. More and more are getting there as far as that's concerned. But yeah, I would ask the question in terms of whether or not there are those options available within your existing superannuation fund or an investment platform that you already have a relationship with. Thereafter, if I were looking for a plan, my question would be, for any investment and any strategy, it's, can I do better? I think that's a really important question to ask of your fund or your advisor. Can I do better? Can you do better in terms of that outcome? What are the levers that we can tweak to better deliver me income for my chosen lifestyle in retirement? How can you better match the income that I draw to my desired level of spending? How can you make sure that I've got income that can help me sleep at night? How can I be appropriately exposed to growth assets through a long retirement? Because absolutely, we spoke earlier about creating a passive income for retirement. I think that's a really important element. And most of us are going to need growth assets going the distance through retirement as well, because it is such a long time that most of us will live through retirement. So making our income last is a really important consideration. And then ultimately, I'd get down to my individual preferences. What's gonna help me sleep at night? And for me, I don't think a product solves that. I would really say that it is advice and understanding that solves that. And so, really pleased that you've got so many listeners dialing in and listening in to these sorts of things. Building building confidence in your retirement is really important. And part of that's knowing the tools that you've got, but the blend of those tools and how you build those and construct them and how an advisor might help, I think, is a really important conversation to have.
Yeah, I like that. I really do. And that's the thing, right? A lot of people want to outsource retirement to experts, rather, and that's really important. Like I said, to get that advice. And so first, obviously, if you like you said, check out the super funds, speak to your advisor, and just go on this kind of learning spree, because it is worth the going the journey, particularly if you've just hit retirement or you're a few years in. Go to the Challenger website and learn more about these things. Now, you did mention there's literature there for people to check out. Is there anything in particular? I'll put a link in the YouTube description and in the podcast player, but is there anything in particular you would direct people to, Andrew?
Yeah, so I'd start out with the challenger.com.au website, and effectively on there, the content about retirement planning, I think, is a really useful starting point for that conversation. And it talks to some of the issues that we've had the opportunity to talk about today, and some others as well. But yeah, those categories of Australians that might have some significant benefit that comes through an allocation to a lifetime annuity. I think we've tried our best to highlight the sort of role that it could play within your retirement portfolio.
I think the idea of a guaranteed monthly income that adjusts for inflation, which is the real kind of like silent killer of retirement budgets, is such an important thing to talk about, and it's appealing to a lot of people that watch this program. So, Andrew, I really do appreciate you taking the time. I doubt this is the first time we're going to chat, but it was a wonderful conversation. I really appreciate you taking some time out of your morning.
It's been a pleasure. Thank you very much.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.